We were told that the banking system was safe and sound. We were told everything would be okay. This was not 2008 because the banks are well capitalized and there were regulations in place to make sure that we didn't have another financial crisis. However, today we see the true effects of keeping this monetary policy of easy money in place. And now we are feeling it. We're starting to see the ramifications of such a insane policy for such a long period of time. Emergency measures were put in place towards 2009 that were supposed to be temporary emergency measures, and yet they continued all the way through. And now today, quantitative easing and cutting interest rates to super low levels is seen as automatic and justified. While back then in 2008 into 2009, Congress and just about everybody else was shocked that they would do these things, that the central bankers would go to these lengths, that they would actually be purchasing things that they previously would never have done before. Now today, it's expected and assumed that they're going to intervene each and every time there's a small problem, medium-sized problem, large, it doesn't matter. They must intervene. And every time they do, they devalue your currency. And I want to start with that. You came here for the truth, so let me unveil that for you. How about this? You're looking at Michael Barr. I believe he's the vice Fed chair. And he said this: banks are safe and sound. That's the quote. Banks are safe and sound. And so I put this here on Twitter because I thought I might want to be able to reference that one at a later date, but we'll see what happens. And of course they weren't. We were told, they're well capitalized so that we do not need to worry. But we have found over this period that it isn't a matter of how much capital they have. It's the fact that they have liquidity problems. And a lot of that is based on the fact that really what had happened was everybody, the Federal Reserve, the government, along with the Treasury, you look at all the analysts, everybody was on the same page. And that is inflation is transitory. Inflation is transitory. You remember that? Team transitory. And so if they believed that that was the case, well, then they would make investments accordingly. And you see with the example of SVB that they did so and it really backfired on them. And so in this case here, we are witnessing the problems as a result of that. And that's why we should never believe at face value what they tell us. We can take it in, okay, that's fine, I'll put it back here, I'll remember that, but I'm never going to say it's transitory, like an event into the future, and then bet based on that event that hasn't happened yet. Those predictions generally do not work out. And so we see that today. I personally only take the facts. I only take what I have today, and I take history and I look at that. That's what we can measure right now. Into the future, we don't know. We can make sort of guesses and educated guesses and position ourselves, but we don't want to overextend because that tells us that we could determine the future. And the last time I checked, my crystal ball wasn't exactly something that I would consider to be what I would go with. Okay, that's just not the way it works. Brazilian billionaire says any intern would have seen SVB risk. Says this generation doesn't know how to deal with inflation. And the quote is right down here. It's a very basic asset liability management that any junior analyst working at a bank in Chile, Brazil, Colombia, or any other country that presents a little more volatility would know. So those countries would know that inflation goes up and down, that interest rates rise and fall. These are cycles. But for everybody today, not everybody, but most people working today, they've gone through their entire working experience only having super low interest rates and low levels of inflation. So of course, that's the expectation. Do you see what the problem is here? That as soon as interest rates rose, which of course I said they would, because they have to at some point when inflation rates rose, at some point, something's going to happen where inflation is going to go up. Then interest rates have to be there to meet it. In fact, should be exceeding it in order to bring that down. And so we are watching this today of people being dumbfounded. Oh, I didn't know inflation could go up. That's possible. Well, of course, you do all these different things, you're going to affect it. And then what the next part that what he said was, it was a gross mismanagement of your interest rate mismatch, and any intern would have been able to see that. They'll learn it in the first 3 months of the job. Okay, so I agree. Anybody should have been able to see that, but they didn't. Why? Because they were told team transitory, as well as this is all just something that we need to just, don't worry about it. It's going to be quick. It's going to be quick. They're going to increase interest rates. Don't worry. It's going to be quick. Not the case. Bulk of maturing Class B and C mall loans will likely default as access to capital gets harder, and that was before banking troubles sent a shudder through the markets. Regional and local lenders represented approximately 46% of financing for retail real estate in 2022. This to me is extremely concerning because it shows us that the small and mid-sized banks play a big role. They play a very big role in what happens. It's not just the JPs and the Goldmans and the Bank of Americas of the world. It is actually the small and the mid-sized banks that have a large percentage of that. And so they have the exact same exposure that SVB did. Maybe not as extreme, maybe it's less total in dollar value, but they still have that exposure there. And so these dominoes have yet to fall. And the FDIC, the Federal Reserve, the Treasury, they can all come out and say we are going to bail them all out. But let me explain something. A bailout doesn't fix a problem. It doesn't fix a problem at all. And you're going to put a Band-Aid on all these gunshot wounds. Okay, sure, but you're not actually fixing the source of the issue. You're really not. It's bailing out. You're bailing out the boat, constantly bailing out this boat, but there's 100 leaks in it. And so you're just going to sit there trying to bail out that boat. It's going to sink, it's going to sink, it's going to sink, and it's going to take you down with it. Do you see the problem here? They do not want to actually resolve the issues. They're going to create inflation to fix this crisis. They're going to create a lot of inflation, and they know this. And how do I know that? You can read the speech by Ben Bernanke, the most important Fed speech ever written, in my opinion. It's by Ben Bernanke. You type into search engine 2002 Ben Bernanke speech Fed, and the actual title is Deflation, Making Sure It Doesn't Happen Here. And one of the things he mentioned was a 40% devaluation of the currency that took place in 1933, saying that was a good idea. We'll do it again. What do you think about that? You want your currency? Let me know in the comments below if you would like your currency to be devalued overnight by 40%. Let me know. I'm not even kidding. Would that be okay? Because this is what you're voting for. You are voting for the inflationary policies, and that is exactly what you're going to get. Used car prices are rising again. Here we have it. We were told that's it. It's all deflation from here on out. It's not so simple. It's not so easy. And you could look at cars, you could look at rent and mortgages, you could look at anything, and the costs are up. Just take it year over year over year, and you see what's happened. It shouldn't be something that should surprise anybody. Or is there greed? Is there, of course, people ripping people off? Yes, absolutely. Price gouging, all these things are real. But at the same time, fundamentally, when you print literally tens of trillions of dollars globally in just a couple of years, you're going to have a lot of garbage that happens, and it throws all the stats off. Nothing makes sense anymore. Companies mentioning job cuts versus job shortages. Look at this, job cuts at the orange kind of line there. And you see that has been rising through 2022 into this year. Labor shortage just, happens to be less of an issue for these companies on their earnings calls. So they're mentioning now a lot of the cuts. Hey, we're going to get rid of people. We're thinking about getting rid of people, or we're talking about other people in the industry getting rid of people, instead of saying we need more people. Do you see what's happened here? And what is the big change at the exact moment was rising interest rates. Of course, they're borrowing money. It's costing more money to do so, and they have less capital to work with. Commercial real estate has been recently slaughtered as investors grapple with low occupancy rates, high leverage and refinancing costs, and the potential credit crunch due to the regional banks being big commercial real estate lenders. Big stuff. And that's all I wanted to mention with commercial real estate. I would highlight the fact that you've got problems with the malls, you've got problems with all these big office towers, you've got a lot of different issues that are there for commercial real estate. But of course, centrally, it is interest rates. Now, I do believe personally that they are going to cut interest rates pretty soon, relatively soon. The market has already started to price in based on the middle of this year. So in that June, July timeframe, that we would see our first interest rate cut coming from the Federal Reserve in order to stop this recession. But of course, their actions are usually delayed. So does that mean they're going to admit the recession before then? I really don't think so. Look at the stock market. Stock market is doing very well. Job market is still relatively robust compared to historically what we've seen in different crises. I don't know how you can justify a cut. I really don't when inflation is this high. But the point here is that they want to create more inflation. Why? So that they can create a divide in between the rich and the poor. And that divide, a lot of people, I'm going to go up to the top. Chances are you are not. There will be a very select few. Look at these developing nations, okay? If you look at any developing nation, nations with, a lot of problems, let's say, they usually have an elite class at the top and then basically everybody else. And that's the way it's looking like for most of the Western countries where they're going to. Not a good sign here, okay? And now I need to show you a few things. I mean, we're getting here. We're getting to this level, and it appears to be everywhere. New show of anger as French protests Macron pension reforms, as well as this. French police counter protest violence, garbage strike ends. What I am noticing is that the people are taking it to the streets. I wrote on the back of my second book, Global Economic Collapse, on the back of it, it says, soon the earth will rumble under the heels of the angry mobs. And it's pretty clear and evident that we are witnessing that today for different reasons. But the point here is that when people don't have enough, when they don't have prosperity, when they're being pressured and pushed down, they will react. And we are witnessing some of that here now today. It could be for anything. I mean, look, you're going to have to raise your retirement age, 62 to 64. You're going to have your pension slash. It doesn't matter. People had enough. If they were prosperous, if all of these people that were protesting had millions and millions of dollars, they lived in homes with no mortgages, they had an abundance of jobs and work and so on, would they be protesting? Very unlikely. It is in a circumstance in which people have had enough that they get out there onto the streets, and that's what's coming for everybody. And you got to understand, people think, well, I'm going to be okay because of this and that, but as they say in this article right here, the jobs most exposed to ChatGPT, and they're just talking about AI in general. And I think it's important people get, understand what's happening with artificial intelligence and robotics and so on, that your jobs will be replaced by them because the companies, they don't care about efficiency. They don't care if maybe you do provide a better service than that robot. They decide things, the big companies employing a lot of people, they decide things from a boardroom. They've never seen your job. They've never done your task. And in fact, they don't care. The point is that they have to appease the shareholders, and they will do so by firing a lot of people and having AI and automation increase productivity. If they can write the words increase productivity, they will get shareholders to love them a long time. A new grocery rebate, this comes out of Canada, and you can see the way that they are fixing inflation is by generating $2.5 billion out of thin air and then, hey, just giving that to people. This will not resolve the inflationary problems they have, but of course, Canada has to pay for that. The Canadian taxpayers are going to get money from their taxes that's going to give them back money to buy groceries. If you think that makes any sense, please let me know in the comments below. We are going to tax people, and then we're going to give the money back to them. Okay, sure. I guess maybe I might have had trouble understanding it, but if you could explain that to me, I would really appreciate that. I think we've had enough for today. All right, I am high on my espresso. I'm feeling good, and I want to thank you for being here. But the question I have is, are you an insider? And insiders are able to get the video of the day directly to them. They also have a channel to be able to get to me. They might shut me down. They might restrict access to my content, and the way you get to that is the moneygps.com. It might be right here, the moneygps.com. Scroll down to the bottom, fill in your email. I'll send you the video of the day, and that's it. I'll see you tomorrow. Take care.